Hey everyone, D-Cope back here at IPA. This is day 7. So we're going to get to where we are in the presentation after the disclaimer, but this is all for educational purposes only. So just keep that in mind. We are in week 2, mechanics of the market, where we're talking about all the building blocks of the market, and it's important to understand to get a good foundation underneath us. So we talked about currencies yesterday, and today we're going to talk about commodities. So commodities can be very important depending on what market it is that you chose to align yourself with. So today we're going to be talking about what commodities are, for those of you that don't know, why it matters to you, then how the commodities affect the market. Then I'm actually going to go online and show you where to find the raw data. And this is just so you know where to get the raw data. I don't expect anyone to actually go in there and use that raw data. There's other tools on the internet that I'm going to get into after I show you the raw data, and that's the free COP data, and I'm going to show you that website as well. And then I'm just going to tell you a little story about the commercials. And it's not TV, it's not the TV commercials. It's a term used in commodities trading to represent the producers and the ones actually at risk if the underlying commodity price were to fluctuate. So they do things to offset their risk, to look out for the future of their company. And that's really, really important to understand as well. So here's what they are. In energy, there's oil, natural gas, etc. And the softs is what they're called, is cotton, coffee, OJ, things like that. And metals, you have gold, silver, platinum. Your meats, you have your live cattle, lean hogs. And grains, you have your soybeans and your corn. And these all can affect the stock market. So don't think that this is irrelevant to you just because you focus on technology companies. That's influenced by the price of some of these other things. Metals, I guess, would be technology. So why does this matter to you? Why am I trying to stress the importance of commodities? So commodities, just like everything else in the world, there's a range, there's a price range to each commodity, and it's very much cyclical, just like the market. So when something's bought and sold, there's a balance there between supply and demand. And sometimes the supply is much greater than the demand for the underlying asset, the commodity. So if you're in business, you're paying very close attention to your underlying commodity price, whatever you're selling. So I'm just gonna throw out an example of, let's say, you're a farmer and you're in the corn business. So you sell corn, and your biggest fear is that corn is gonna drop in price and it's gonna get hit like 50% and you're worried about that. So there are tools that you can use to offset your risk to the downside. And they're actually called options. Now, options seem a lot more complicated because, people like to talk about options strategies in the market. But really, options have been traded, ever since they were trading, ever since they were trading commodities, basically. So let's say here's the corn market. So the price of, I think they're bushels. I think the price of a bushel fluctuates between $300 and $400. So at $400, you're profitable, you're loving life, and at $300, you're pretty much bankrupt, and you're gonna have to do something seriously to save your future. So what you can do is in July, when everybody's getting all crazy about corn and they're buying up bushels, because you're in the market and that's the height of the demand, you can sell way more corn than you have. And you'd be short those bushels of corn. But you're not worried because that people are just a little crazy in the summertime. They get crazy about their corn. They love corn, and they don't get any idea to invest in the commodity in October because it's already faded for them. Their mind was on it in July, but in October, nobody's talking about corn. So in October, you can go ahead and buy those 1,000 bushels of corn back on the open market, and you're going to make that difference in price. So times that spread by the amount, and you'll get that number there. So in this example, it's 10,000. So, that's a basic analogy, but it's more important to understand that there are commercial hedgers that are doing this and it's to mitigate future risk for themselves so that they're not exposed to market conditions. So we're going to talk about the commitment of traders data. And this was data that was released to the public, and there were people that fought to keep this data public. And it is pretty important, especially if you're in that industry. So you don't need to be in a certain industry to tell when there's a price anomaly, and if the commercial hedgers are betting a certain way, there's no one that knows their industry better than the people in it and the companies in it. So of course you can buy and sell stocks that are influenced by the trends being realized in the underlying commodities as well. And you'll see the same patterns emerge in a sort of market resonance. And I love this quote. It's when you can hear your market, your whole life will change. So I encourage you to look at this commitment of traders data. Don't just push to the side. And I'm going to show you after the presentation, I'm going to walk you through the sources online that you should definitely look into. So how commodities affect the market. Well, oil prices affect drilling companies and oil companies. Gold prices affect mining companies. And, the softs, meats, and grains, they affect their respective industries' companies as well. It's not as significant for some companies because they've been in the market so long that they know how to offset their risks from price fluctuations. And if it's a huge company, like let's say Starbucks, it's not really affected by the price of coffee all that much because it's kind of a consumer staple. It's gonna go up over time. And coffee, the cycles in coffee are probably not going to be. You're probably not going to see that price fluctuation reflected in the price of Starbucks. So just know that there are some companies that are more affected by the changes than others. And now I'm going to tell a little story about the commercials. So the year was 1987, and Larry Williams set out to make history. Larry entered the World Cup of Traders to prove his personal method was not only effective, but that it was the best. The competition lets traders compete to track who can gain the most money in 1 year, starting with $10,000. So one of Larry's advantages was he studied the commitment of traders reports. That's short for COT reports. So the COT reports are released by the Commodity Futures Trading Commission, the CFTC. So volumes of buying and selling, that would be long and short positions, for common commodities are released to the public weekly. And I'm going to show you exactly where that data is. More importantly, this report separates the commercial institutions and hedge funds from the new positions from the non-commercial and unreported buying and selling. So the non-commercial traders aren't as important to follow as the commercials. The non-commercial traders, that's kind of the noise that you want to tune out. It's going to distract from the message. So the commercials are buying and selling to lower their risk because their business is at risk. If there is a large movement in a commodity price followed sharply by a reaction in buying or selling large volumes from the commercials, that's an indication that things are about to change. And I'm going to show you if you don't know, if you're having trouble visualizing, don't worry. I'm going to walk you through all the COT data in a second. But that was largely Larry's plan. He came out and he was trying to tell the world how he did it, and it was by betting with the commercials in situations where he was most confident because of the indications. So at the 12-month mark, when the World Cup of Traders competition ended, Larry achieved net gains of 11,376%. The next highest return since the tournament's inception was not within 10,000% of it. That's a difference of over $1 million all in 1 year. So, the market conditions in 1987 had a lot to do with Larry's returns. But the returns had everything to do with Larry's strategy and his tactics. So this is a teachable skill as well, because 10 years later, Larry's daughter won the same contest and finished up 1,000% at the 12-month mark. So Larry, he's got a website, and he's made millions multiple times trading. And we should be listening to true masters in their market. And Larry's a proven master of the commodities world. So I'm just gonna exit the presentation for a second, and we're gonna go online, and we're gonna look at the CTFC website. So if you just type in CFTC on Google, this will bring you to the U.S. Commodity Future Trading Commission. So if you go to the Market Data Analysis tab and you click on the Commitment of Traders, it's going to bring you to this page, and you're going to want to click on this historical viewable, and that's going to get you closer to the raw data. So this data, the one week alone is not going to give you any insight on where things are going. However, if you look at the change from the week before and the week before, the longer history you have, the better idea you'll get of what the commercials are doing and what's going on in the industry. So I'm just gonna click on petroleum and products just to show you, how the raw data is. And so let's just go down to the bottom. So everyone knows crude oil. So this producers, merchants, and processor user, this is the commercials. So here's the open interest, and here is the contracts in 1,000 barrels. So you can see right here, they're long 23,000, they're short 22,000, pretty balanced. So this doesn't really mean anything because we don't know what it was last week. So, if we wanted to go back and look at a previous week. So if we looked at January 9th and we looked at petroleum products, you're gonna see different numbers here. And so that's what we were on. WTI crude. Okay, so they were long 21,000 and they were short, about the same. So I'm just showing you where to find the raw data. This isn't going to help you all that much. The next site has the data analyzed for you. So if you just type in COT data, a few down on Google, you'll see free COT data, and you're going to click on that. And this is the action item for today. So you're going to want to go on this freecotdata.com, and the action item is to make a prediction a month out on the commodity that you feel most comfortable leaving money in. Now, obviously, you're going to see different data because you're going to be watching this sometime in the future. So, if you look at the cocoa COT reports, we can see the green is the producers and the users, and what is this light blue? So the light blue is the speculators. So the speculators, they're kind of seen as the dumb money. And, don't get offended if you consider yourself a speculator. I consider myself a speculator. But it's just important to realize that the producers and the users are the most important. So I'm trying to find something that really hints as to where the prices are going. So this is not a bad example at all. So you have copper here, and you can see that the producers weren't really buying at 268 back in December of 2016. However, they started buying as the price kind of remained stable, and it only fell a little bit, and then it got to 250, and now the commercials have kind of stopped buying as much because the price is relatively high. So this might be an indication that the prices are getting relatively high compared to recent history, and this may be a time to sell copper. I'm just throwing out these ideas. So corn, it's funny how there are spikes in July. Knee high by the 4th of July. So people do get crazy about corn in July. And, that's probably where a lot of bushels are sold. So in July, you can see the speculators 94%. Now, another important thing to realize is, like I said, it doesn't matter how many contracts are being bought and sold. It matters how many contracts relative to what it was. And that's important to realize as well. So here, back in 2013, the price was $4.24, and then the price rose to $500, and the producers and the users stopped buying as much. They went from 100% to 35%. So that's an indication that prices are relatively high and that there's going to be a correction of the prices in the market. So a few months go by and the price falls to $3.50. And you can see the producers and the users have now bought more relative to a few months ago. So you can see how the cycles in buying of the producers and the users, they're affecting the price of the market. So trying to find more examples. So a lot of speculators on cotton. So I'm trying to find. So feeder cattle. So the producers and the users, they weren't buying anything in November. And in December, it was 17% was the 5-year percentile of net position. And I'm going to go through the bottom, and it explains a little bit about the percentile. But it's basically what I said, in that it's not really the amount of contracts being bought and sold that matters. It's the change in the amount. So that's really important to realize. But so the speculators, they've kind of fallen off a little bit, and that's usually good for prices when there's less speculators. So let's see here. So heating oil, I'm looking for a chart that gives me confidence that something is going to be worth more in the future, because that's the action item for you, is to pick something and to check back on it in a week and 2 weeks, and to actually follow the movement. So if I had to pick something, so here, orange juice. This doesn't look like a bad idea, a bad trade idea. Certainly, technical analysis of the chart has something to do with it. But with commodities, remember, it's cyclical. So there's going to be cycles. So you're going to want to buy low and sell high in the price range, in the historical price range. So 500 to 1,000. I don't exactly know what's driving the market, but there is a lot of speculation. And so if I had to do this, I may go with orange juice. Although crude oil looks pretty strong as well. So this is interesting because producers and users are buying more, and speculators are buying more. So you don't usually see them aligned too much. Yeah, so I might go with crude oil. And so I'll check back in a month and just see if I had the right idea. So let's look at how to use the data, because this is important as well. I showed you where to find the raw data, and it's the same data that they're using. So how to interpret COT data. In a nutshell, analyzing any one COT report in isolation is pointless, as I was saying. It's crucial to know not if commercials or speculators are net long or net short, but rather how extreme their position is relative to the past. This particular site uses percentiles to give context to the current net positioning number. For example, consider the position of commercial traders in corn over the past 5 years. If their most bullish position had been net short 12,000 contracts and their most bearish position had been net short 555,000 contracts, then the current net COT position of net short 426,000 contracts would translate to a 5-year percentile of 24%. A percentile of 0% would mean that commercials are more net short than they've ever been in the past 5 years. So it's very, very interesting interpreting this COT data. And I'm definitely not an expert in this. So you want to do your own research as well. And if you have some pretty convincing data that's saying something other than what I'm saying, take the convincing data. I knew many commodities traders that made a lot of money buying and selling options contracts, and they made the most money on localized events. I had a coworker who made $30,000 by buying options before a hurricane hit in Florida. So local events can definitely have huge impacts on the price of these commodities. Everything is affecting the market. So don't ignore the price of these commodities, and have confidence that the commercials are making the sound judgment moves. And you don't want to be betting just because there's huge speculation in the market. You want to be betting because there's a solid basis for why the producers and the users are buying more. So just take that into consideration, and we'll get back to that in a few weeks. Just come back and check the COT data and see if you were right or if you were wrong. And it is much of a probabilities game, so there's a chance that you could have the right idea and still be wrong. But that's all I have for today, so I will see everyone tomorrow.